Let's move on to currencies. So what are we seeing what's your forecast as far as the dollar itself is concerned for the rest of 2018? We're starting to see maybe the dollar topping out maybe here?
That's certainly our view. We have been fairly negative on the dollar for the better part of 18 months. The last couple of months has been challenging for that view, but our expectation is that the dollar will start to decline again in the second half of the year. First of all, expectations around the Fed and how far they will take this tightening cycle are starting to flatten out or level off into next year. We think that's important. The U.S. yield curve, as I mentioned earlier, continues to flatten, which historically is associated with a weaker dollar. And in terms of the other side of the ledger, which is foreign currencies and how they'll perform, we do expect, certainly on a selective basis, but at the moment we do expect emerging market currencies in a number of places to start to recover. A number of these exogenous factors have started to stabilize. And I think more importantly, as David mentioned, the underlying economic fundamentals for EM are still relatively robust. The growth slowdown narrative, which we heard repeatedly in the early part of the year, we think that is overstated. Inflation in a number of parts of the world remains well below 10-year averages, even with the increase in oil prices. So I think there is a very good case for a recovery in EM in the second half of the year.
In terms of yields, the 10-year on the U.S., you think it'll stay under 3% or it could...
Our expectation is that the 10-year yield will finish the year above 3%, but I want to clarify that or add some color. It's not an expectation for a significant move higher.
Okay.
We see 10-year yields centering or finishing the year around the sort of 310, 320 area. For us, the big increase in yields is still going to occur at the front end of the yield curve. So by the end of the year, we would expect the U.S. Treasury yield curve to be completely flat from a current level of about 40 basis points.
So we've got 3 central bank meetings, right? I mean, Fed, ECB, and the Bank of Japan this week.
Yeah.
Fed expected to hike 25 basis points, and the other 2 to stay pat?
Yes. The important part with the other 2 will be discussions around their meeting and program rather than any action. That's for sure. Yeah.
Okay. In terms of emerging market currencies, do you think it's, I mean, the Turkish lira, for example, or what's happening in South Africa or Brazil or all these currencies, is there, the common thread is QE ending and markets having to price assets without QE? I mean, central banks behind them?
I think there's an element of truth to the shrinkage of balance sheets and you know, some have called it quantitative tightening. I think there is an element of a drain of liquidity. But at the end of the day, I think what has really been troubling for a number of these markets that you've just described, whether it's India and Indonesia earlier in the year, South Africa more recently, Turkey, is the increase in oil prices and the increase in the dollar at the same time. Right?
But both can't go on, right? I mean,
they can.
Yeah.
The old saying is markets can be irrational longer than you can remain solvent, I think is always something to keep in mind. But it is a break from historical correlations. Historically, when commodity prices are rallying, you would expect to see foreign currencies rallying or the dollar weakening. That gives central banks an important bit of policy flexibility, which they've lost over the last couple of months.
Sure.
So you see, for example, the central bank in Turkey, now Brazil, India, Indonesia, adjusting their policy path to try and defend their currency, to inject some stability. Now, it's our expectation that oil prices will be more stable around current levels. If our dollar view comes into play, all of a sudden central banks will find themselves with an enormous amount of policy flexibility. And you saw that in Brazil at the end of last week.
Sure.
India and Indonesia have already started to perform quite a bit better over the last few weeks. So, yes, liquidity is important, but there are other factors as well.
So what's the view on oil, the house view on oil, David?
Well, we've been historically pretty bullish for a number of years on where oil would go. And the key underlying driver was demand was never really the issue. It's always been relatively decent pace of growth, driven, again, by the emerging markets, more even than developed markets in terms of the delta. What's been the biggest story was to do with shale, U.S. shale production, how much it would be able to survive and then to pick up. Now, the stage that we're at, what we're watching for is that with the oil price targets, implicit targets, effectively met, and the achievements of the collaboration between OPEC and other countries has achieved their objectives, now we may end up, because we're risking going outside of the Goldilocks range for oil prices. And that's something that we need to be wary of, because we would have expected that shale could have taken up even more of the slack. But there's a lot of drop in supply coming. One, it came in from Venezuela. Two, from what we are likely to see from the Iran's output post Trump's announcement again on the deal. So this means that we're in a more precarious situation on the inventory side. And that means that if there's any risk to our view, which is we stay where we are at least and maybe slightly higher, that it's actually upside risk still to where oil prices go. And that, I would argue that once you get WTI in the mid-80s or high 80s, that becomes no longer really the Goldilocks scenario that we had been anticipating.
It's great for producers, but it starts to hurt consumers.
Yeah, well, the other challenge for producers is if you go up that high, it also removes some of the more urgent need for reform. And so actually, Goldilocks from many perspectives would be if we were, say, around where we are today.
And you think most likely that is the case?
We think so. We think we will start to see a little bit of output picking up, for example, from Saudi over the coming months. And there will be some producers that can meet some of the drops in others' output to try to stabilize prices. So I would say and this underlying demand story, as I say, the underlying fundamentals are still relatively strong. And they're unimpacted, we would say, so far on a worldwide basis, and I think this will be true for a number of years, unimpacted by the electric vehicles.
India, where do you stand? The rupee, the strength of the local economy in the global setup, Rick?
Yeah, I think, look, India has had a couple of challenges this year, some of them domestic, some of them what I would call exogenous factors. On the exogenous side, as we mentioned, the increase in U.S. interest rates, the increase in the dollar. India, as you've just alluded to, is an important importer of oil. So oil prices going up as dramatically as they have, combined with currency weakness, you see a real deterioration in what we call the terms of trade, right? And that's something that the RBI has been quite heavily focused on recently. The other issue is the bond market. Right? In an environment where global interest rates are going higher, we have seen demand for the onshore government bond market decline. We've seen 10-year yields up around 8%, which is historically quite a high level. The spread on 10-year yields relative to the repo rate remains quite high. So our argument at the moment is valuations for Indian assets, whether it's the currency or fixed income, are extremely attractive, but you need to see some signs of stability. I think the Reserve Bank of India's decision to start raising interest rates is an incredibly important marker. I think it will be the start of an inflection point where you will see Indian assets start to perform better because the RBI is saying we want to get out in front of the curve.
Do you think there's only one rate hike here, or there's never one rate hike? I mean, it's the start of the cycle.
Well, you never say never, but our expectation is that there will be a follow-up rate hike in August.
Okay, and beyond that, it's not a deeper rate hike cycle in that sense, you think?
I think I would make the comment for India, which is similar to what we have expected in a number of other economies around the world, especially in the emerging economies, which is that we have expected a mild normalization of policy, one, maybe two rate hikes. Beyond that, I think is very difficult to expect much more. We've seen a couple of rate hikes in Indonesia, similar in Korea, but again, we're not expecting a steep policy trajectory, and I think that's quite important.
And if I may jump in, actually, the reason that we would argue ahead of consensus and expecting the hike that we just got was because of this combination of looking at what was going on elsewhere, thinking, why not be preemptive? And on top of that, factoring in the impact from the rise in oil prices, given its importance on driving inflation. And if you're more upfront about it, then you may end up needing to do less. So the key driver of whether or not we'll call for many more to come, or actually only one more to come, which is all we're calling for, will end up being on this external issues to do with how the currency is performing.
We'll leave it there. Thank you very much, David and Eric. Appreciate both of you coming in and speaking with us. Thanks indeed.
Thank you.
Thank you very much.